It is Thursday, September 17th, 2020. This is episode number 74, Cash Balance Plan Part 8. What is in our portfolio? This is the 39.6 Facebook Live Finance Show. This is the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, and even the car you drive. Today's episode, number 74, what's in our bag? You know those YouTube videos or whatever videos where people like open up their bag and they just show you all the stuff they have, like an unboxing? Well, here you go. We're going to unbox our cash balance plan today. All right, and I've already alluded to our portfolio a little bit before, and you can talk to a lot of different advisors regarding what money or to put in, how to manage it. A lot of different advisors for cash balance plans do different things, okay? And yes, this is another really boring episode. I think I'm gonna lose all of my listeners because we've done this for like a week straight. We really have to put an end to this topic because so many people don't have them or can't get them. I have to do like a real estate talk and then people will listen again. But okay, what is our actual portfolio? It's always interesting. A lot of people don't share their investments in their portfolio. Other people do. And sometimes, it's just interesting how much people can be interested in what other people have. So this is what we have. We have a pretty simple bread and butter portfolio because we have a large plan, and I did not want anybody complaining about our investments, saying, why did you choose this? Why did you choose that? So we went with Vanguard as our investment advisor. I'm going to take off the title, and I will show you our very simple, cut and dry investment allocation. Okay, so it is basically very close to, but not exactly the same as the Vanguard Life Strategy Conservative Growth Fund. If you are out there and you can hear me, please just let me know, confirm that the audio and the video are working. Let me know where you're from, what you want to hear more about. If you have any questions, I'll try to answer some questions today if you put them in the comments. All right, so our pool is basically very similar to this Vanguard Life Strategy Conservative Growth Fund, VSCGX. And in fact, in my personal capital app, which is how I track my finances, our portfolio, because we have way too many accounts. We have like 20 plus accounts. I don't really honestly know, but it's a lot. It's all combined there. And because the cash balance pension has a number of different funds in it, to make it easier, I just use this because it should be pretty close. So this Vanguard Life Strategy Conservative Growth Fund, Vanguard has these fixed allocation funds, which I really like. They have one that's like 20-80, one that's 40-60, one that's 60-40, one that's 80-20. They all have different names. This one's called Conservative Growth Fund because it's 40-60, 40% stocks, 60% bonds. And it sways a little bit plus or minus, and I printed this out from August 31, and at that moment it was 40.2 and 58.7. Okay, but it's basically a 40-60 allocation. And how do they break that down? Well, the stocks are 40%, and that's broken down like this. Total stock market index fund, like VTSAX, is 24%, and the total international stock index fund, like VTISX, I think, is 16.3, or the ETF versions, VTI, which is the total United States stock market, and VXUS, the total international. Okay, so 24 and 16 makes 40. So basically, of the stocks, it's 60% US and 40% international. Then you have the bonds, and it's 60% bonds, and here is broken up 42% US versus 18% international. So 42 out of 60%, that is 70% United States and 30% international bonds. So it's like a 60-40 split of US to international for stocks and a 70-30 split for bonds. It's pretty much the same split they use in like their target date retirement accounts. It's pretty bread and butter Vanguard. Okay, so that is very similar. What it really is, so it's still that same breakdown. We still have a 40-60 allocation. So you see the 40% here and the, actually there, 40% there and the 60% there. Okay, and with the breakdown that I had just mentioned, 24-16, 42-18. And here's the actual breakdown. Okay, so this is a pretty typical Vanguard pension fund breakdown. They have their basically all index strategy. They also have an actively managed strategy, and actively managed strategy we just didn't go with. You know, the ER is a little bit more, but it's really honestly not much because they're still Vanguard actively managed funds. But we just wanted something a little bit simple that was very straightforward. And so it's basically the same thing. The 40% stocks is 24-16. And the bonds is 42-18, just like we had shown before. However, the one difference is on the bond side. Instead of just being 42% total bond market, they cut it in half. And of the United States bonds, half of it is total bond market. But then the other half of it is broken down into short, intermediate, and long-term investment grade shares. So what are investment grade shares? These are corporate bonds, but very high grade corporate bonds. And why do they put the corporate bonds in there? It's just to tilt it a little bit more toward higher yield. They're still super high, good grade bonds. They're not junk bonds, right? But the yield of bonds is a little bit higher, and of the corporate bonds, so the investment grade bonds. And we're targeting is trying to get to like 5%. So, you know, given that treasuries have a very low nominal yield, corporates give you a little bump, okay, without too much risk. Now, you can still make capital gains on either end of the coin with treasuries or with corporates. But anyway, so this is just a very slight tilt to corporates. Fine. And they're all index funds. It's 40-60. It's very easy. Okay, nobody can really complain about this. If you're trying to get 5% every year, I mean, frankly, the easiest way to do that is to buy real estate assets that are super unleveraged. I mean, you can buy a property, like a grade B property with basically a 5 cap. You could buy it in cash and you just have the cash flow. The problem with that is it's not liquid. And in a long-term pension, that's great. But in a cash balance pension where you're thinking of closing it out, you need to be able to liquidate. So anyway, we're using publicly traded securities. But really, having some alternative assets actually can be really nice, especially if they're in the liquid variety. But just for the simplicity of using a pension in a gigantic group, we're just doing this. If I were running my own pension, just like for myself, I would probably put some more alternative real assets in there. Okay, so that is it with our actual fund. I'm throwing in one more just for demonstrative purposes. This, and a lot of the information is really hard to find. I have a bunch of portfolios from different places, but they're all like, this is not for public display. This is for institutional private use only, not for retail investors, blah, 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 blah. So I can't really show them legally, I don't think. But this one is available on the internet. Fidelity Institutional has a page on their cash balance plans, a little bit, but you can see this market-based cash balance 3070, basically this fund, okay? And this is a fund that basically is what you could be using in a cash balance pension. And it's 3070, which is a very good asset allocation for a cash balance plan because the downside risk is very low. And remember, we're trying to preserve principal. And so actually, I would have probably rather gone with 30/70 to be honest in the pension, but so many people wanted to be more aggressive than 40/60. So whatever, 40/60 is fine. And so here it is. So they basically do a 30/70 allocation. They use minimum volatility funds. So this is one way to go. They use an iShares USA minimum volatility equity fund. Another one, iShares EAFE, that's international, Europe, Australia, Far East, minimum volatility fund, 4%. And then 20% FIM global low volatility equities. And that's like the total equity market. So it's 30% bonds, and they're using these minimum volatility funds. And actually, I really like the idea of minimum volatility funds because it decreases the standard deviation. It minimizes your downside risk, in theory, if they actually are low volatility. And then on the fixed income side, they have 70%. Okay, half of that is iShares Core U.S. Aggregate Bond Fund, so basically a total U.S. That's 35%. And then 30% is the Vanguard Short-Term Bond. And then they have another 5% of a inflation-protected index, like a TIPS fund. So nothing fancy there. They use basically all U.S. bonds. It looks like, I'm pretty sure the Vanguard Short-Term Bond Fund is just U.S. bonds, includes treasuries and corporates. And then you have this small international, looks like international inflation-protected index, 5%. But the minimum volatility is something that's really interesting and something I really considered. I've talked to a number of groups, and some of them, they say, oh, we have this proprietary minimum volatility algorithm, and we back test this, and then it never lost more than 1% in a year, and it's perfect for a cash balance pension. And then you ask them how long they've had it around, and they've had it around for like a couple of years, and they back test it like a decade. And I mean, you can back test something a decade if you make it today. You can make it look perfect. But minimum volatility, you'd often think this might be more heavy in like utilities, right? Because utilities tend to bring in more steady income, and it might be a little bit less on tech, because tech is a super volatile, because people bid on equity investments not necessarily based on what they earn or any fundamental good analysis. Well, whatever. I mean, look at Tesla, went like 4x this year, right? And then didn't make the S&P 500, and then it lost a bunch of money, and nothing changed with the company. So anyway, tech is super volatile. So you might have a lot less tech in a minimum volatility fund. But then you look at the S&P 500, and we're like at record highs right now in the year. Like we went down like 30% in like April, and then we recovered, and then we went above it, and now we're a little bit below. But most of the gains of the entire S&P 500 came from like 5 companies, which were like tech companies, right? So if you had minimum volatility and you didn't have those, then you might be more at a loss. And so I don't know. It's hard to make a decision on this. I didn't really have a strong opinion, but if you have like a low cost minimum volatility iShares index type of fund, I mean, these are pretty safe, good indexy types of funds. I mean, even active management. I know a lot of people hate on active management, but in a cash balance pension, it's not necessarily a bad thing, because you are actively trying to prevent losses. And so there are probably things you can definitely do to minimize volatility. The question is on the cost, right, of these strategies, right? So if you remember that was a long time ago, like 20 years ago, strategery. Okay, that would be it. So I showed you what's in my bag. I showed you what's in other people's bags. There's a lot of different bags out there. There's a lot of different ways to manage a fund. One other cute thing that one of the companies I talked to does, and I've heard of other companies do this, they start with their target portfolio, like 40-60 or whatever it is, or 60-40. And then they hold on to that until, and then they keep watching what the returns are for the year. If they hit their mark for the year, if they're trying to get to 5%, if they get to 5%, boom, switch to cash. Or they're getting close to it. So they might get to like 3% by March, and then they just make it a lot more conservative so that you can basically lock in that gain and then ride it up to hopefully, land at 5%. So you don't end up with a loss. That actually is a very reasonable thing to do to make sure you don't get those losses. But on the other hand, if you get a loss the next year, then you don't necessarily have the gain, and then you're not really capturing market returns. So anyway, this is another strategy, but for a cash balance pension, that can actually make a lot of sense. If you can keep it above zero every year, you keep your pension out of trouble, right? Like if we were at 10% right now, I'd be very happy to take all the risk off the table, lock in 10%, and even potentially hold on to it until next year, and then you average at 5. The problem is you have new money coming in, and if you don't invest that, then you're averaging more zeros, and then it dilutes your return. But anyway, that's our bag. Until tomorrow, this is simply for your financial non-advice. My entertainment, your entertainment. Please consult with any financial, legal, or other professional before making any of your own financial, legal, or other decisions. I am not an accountant. I'm not a financial advisor. I am not an actuary. I'm just a person just like you guys, trying to figure out how all this stuff works so we can make the best decisions to save ourselves on tax and build our wealth faster. All right. Until tomorrow, this is it for episode number 74. We have done like 45 episodes in the past month and a half. Please download, check out, subscribe to the Medicine, Marriage, and Money podcast, released 3 days ago on Monday. Episode 2 will be coming out on Monday, September 21st. So until tomorrow, we will do a 5-minute Friday. 5 minutes. Good night.